Good morning, students. Welcome back to the online learning platform of economics. And in this video, we are going to start the important part of our first chapter, that is National Income Accounting or National Income Calculation. Okay, so there are mainly three methods are there for calculating national income. First one, it is value added method. Otherwise it is known as product method or net output method or industrial origin method. Value added method, product method, net output method, industrial origin method, all are same. Second method, that is income method, and third method it is expenditure method. So actually this national income calculation is starting, or the base of national income calculation is circular flow of income. That day we discussed in the circular flow of income, total value of product is equal to total income generated by factors of production, that is equal to total expenditure made by household on product. Okay, so total value of output, that value is related with the value added method. Next one, that is income generated by factors of production, then that is this income method. And next one, it is expenditure made by household, that is related with this expenditure method. So firstly we can start the first method of national income accounting, that is value added method. Okay, so in the case of value added method, national income is estimated or national income is calculated in terms of value addition of each and every enterprises in an economy. So here national income is calculated in terms of value addition of each and every enterprises in an economy. So the question is, what is value added? I think it may be a new word for you. Value added. So value added is the difference between value of output and intermediate cost or intermediate consumption. What is value added? It is the difference between value of output and intermediate consumption or intermediate cost. So two concepts are here, value of output and intermediate consumption. So firstly we can discuss what is value of output. So what is value of output? Value of output means value of the product which is produced by a producer. Okay, for example, suppose a producer, that is individual A, he is a producer and he is producing commodity X. He is producing commodity X, and in this year he produced 5 units of commodity X. 5 units of commodity X, and the price of this commodity X is rupees 10. Price of this commodity X is rupees 10. So 5 units of commodity X and the price is 10. Then what will be the value of this 5 units of commodity X? That is 50. Value of this 5 units of commodity X is this 50. Then how we calculated this value of output? By multiplying price with the quantity. So value of output is equal to P into Q, price into quantity. Okay, so otherwise, for example, same example, that is individual A, he is a producer producing commodity X, and he produces 5 units of X, and the price of commodity X is 10. And after selling this 5 units of X, how much revenue the producer will get? 50 rupees. If the producer sold his entire output, that means if the producer sell his entire output 5 units, then how much money he will get? 50 rupees. So in another form we can define value of output as value of output is equal to sales. Here sales revenue it is 50, that is equal to P into Q. So this is correct only if the producer can sold his entire output. If the producer can sold 5 units of X, then only this equation will be correct. that is value of output is equal to sales. So P into Q, that is 50, and if the producer can sell entire of his output, then he will get 50 rupees as sales revenue. So at that time value of output is equal to sales. Okay, so two formula or two method we analyze for calculating value of output. First, value of output is equal to P into Q, and second one, that is value of output is equal to sales if the producer sell his entire output. Sometime here the producer produced 5 unit of output. Sometimes the producer cannot sell this 5 unit of output. For example, out of this 5 unit of output, he sold only 3 unit of output. So what is the value of sales here? 3 unit of output, and the price of commodity X is 30. So sales is equal to 30. 3 into 10. Okay, so if the producer cannot sell his entire unit of output, at that time we can use this formula for calculating value of output. That is, value of output is equal to sales plus change in stock. Here sales is equal to 30 plus change in stock. Change in stock means the unsold item. Here 2 unit of X he can't sell into the market, so that will become an unsold item. So what is another name of unsold item? Inventory stock. This 2 will be added along with the inventory stock of that particular producer. So change in stock means closing stock minus opening stock. Closing stock minus opening stock. For example, suppose while starting the business he didn't have any stock of unsold item. So at that time opening stock will be 0 and closing stock, that means he produced 5 unit of output and he can sold only 3 unit of output into the market, and remaining 2 will become inventory stock. So closing stock it is 2. Closing stock it is 2 and opening stock it is 0. So change in stock is equal to 2 into 0, that is 2. Okay, so as per this formula we can calculate value of output as value of output is equal to sales, that is 3 unit of output he sold, 3 into 10, that is 30, plus change in stock. Change in stock is closing stock minus opening stock, that is 2 minus 0, that is 2, and 2 into 10, price of the commodity is 10, 2 into 10, that is 20. So 30 plus 20, that is equal to 50. So here it is 50, and here also 50, and P into Q also 50. So there are 3 methods are there for calculating value of output. First one, value of output is equal to P into Q. Second one, value of output is equal to sales if the producer sell his entire output. Second one, value of output is equal to sales plus change in stock, delta stock, if the producer can't sell his entire output. So that is okay, value of output is okay. Next one, intermediate consumption or intermediate cost. So intermediate cost means cost on intermediary goods. So in the first chapter, in the first video, we discussed the goods are classified into two, that is final goods and intermediary goods. So final goods are the goods which are close to the boundary line of production, whereas intermediary goods, listen carefully, intermediary goods are those goods which are purchased by the producer from other producer. For what purpose? For producing the other commodity or for resale purpose. In simply, intermediate cost means cost of raw material. How much money we are spending for purchasing raw material, that is known as cost of intermediary goods. Cost of intermediary goods. So that is known as intermediary cost. So value added is equal to value of output minus intermediary cost. Good morning, students. This value added method we can explain with the help of an example. Okay, listen carefully. First of all, a farmer, he produced some raw cotton, and here we are assuming that the value of intermediate cost or value of intermediary cost, otherwise the raw material, it is 0, and he produced 1,000 rupees raw cotton. How much rupees? 1,000 rupees raw cotton, and here we are assuming that value of intermediary cost or raw material is equal to 0. Then how we can calculate value added by this farmer? What is the formula? Value added is equal to value of output minus intermediary cost. So what is the value of output of farmer? It is 1,000, and the intermediary cost, it is 0. That is equal to 1,000. So value added by farmer is 1,000, and this raw cotton is purchased by yarn manufacturer. The raw cotton is purchased by yarn manufacturer, and he converted this raw cotton into cotton yarns. So what is the raw material of this yarn manufacturer? It is raw cotton. So how much money he spent for purchasing this raw cotton? 1,000 rupees. So this 1,000 is known as intermediary consumption or intermediate cost. Okay, and he converted that raw cotton into cotton yarn, and he sold it to weaving firm, that is at rupees 2,500. So the final product of yarn manufacturer, it is cotton yarns, and he sold at rupees 2,500. So this is the value of output of yarn manufacturer. And what is the value addition of this yarn manufacturer? What is the formula? Value of output minus intermediate cost. Value of output is 2,500 minus 1,000 is the intermediary cost. So that is equal to 1,500. That is value addition of yarn manufacturer. And this yarn is came to weaving firm. So what is the cost of intermediary consumption or cost of raw material? That is 2,500. So raw material is cotton yarn, and they converted this cotton yarn into cotton cloth, and it is sold at rupees 4,500. So the final output of weaving firm, it is 4,500. Their raw material, it was 2,500. So value of output is equal to, value added is equal to 4,500 minus 2,500, that is 2,000. And this cotton cloth was purchased by garment manufacturer. So what is the raw material of garment manufacturer? That is 4,500 rupees cloth, cotton cloth, and he converted that cotton cloth into different varieties of garment and sold into the market at rupees 7,000. So garments is the final output of this garment manufacturer. His price is rupees 7,000, or his value is rupees 7,000. And what is the value addition of this garment manufacturer? Value of output 7,000 minus 4,500. That is 2,500. Okay, so in the case of value added method, we will consider each and every value added made by each and every producing unit. So here farmer is a producing unit, his value added is 1,000. Yarn manufacturer is another producing unit, its value added is 1,500. Next one, weaving firms value added is 2,000, and garment manufacturer value added is 2,500. So if we analyze this table, then you can easily understand it is producing unit, value of output, intermediary consumption or intermediate cost, and value added. Farmer, 1,000 is the value of output, intermediate cost is 0, then value of output is value added is equal to value of output minus intermediary cost, that is 1,000. Then yarn manufacturer value of output 2,500, intermediate cost 1,000, and this will become 1,500. Weaving firm to 4,500, then intermediate cost 2,500, and it became 2000. Here it is 7000, 4500 and 2500. So what is the final output of this sector? It is garment. So what is the value of that garment? It is 7000. Okay, so money value of all final goods and services produced in a particular country is known as GDP-MP. So here the money value of final good, it is 7000. Money value of final good, it is 7000. So this 7000 is known as GDP-MP, because GDP-MP is the money value of all final goods. Here only one final good is there, that is garment produced in a country during an accounting year. We are assuming that only garment is produced in that particular country, so its value is 7000. So this is GDP-MP. And in the case of value added method, we will consider, for calculating national income, we will consider only the value addition of each and every producing sector. So 1000, 1500, 2000, 2500. So if we add all these one, then we will get 7000. So this 7000 is known as total value added of each and every producing unit. So that total value added of each and every producing unit is known as gross value added at market price. So total value added of each and every producing unit is known as gross. Gross means total. Gross value added at market price. And here we can conclude that this gross value added at market price is equal to GDP-MP. Both are equal. And now we can estimate our national income. Listen carefully. Yes. So firstly we need to add the value added of each and every producing sector. We are assuming that in an economy three sectors are the primary sector, secondary sector and tertiary sector. Now we need to add the value added of primary sector, value added of secondary sector and value added of tertiary sector. How we can calculate value added? Value added is equal to value of output minus intermediary cost. So value added by primary sector plus value added by secondary sector plus value added by tertiary sector. Just to add all the value added like that. Okay, then if we add the value added of each and every sector, what we will get? We will get GVA-MP. That is equal to GVA-MP, gross value added at market price. Then this GVA-MP is also equal to GDP-MP. That is equal to GDP-MP. Okay, next we can convert this GDP-MP into NDP-MP. How we can convert? Minus depreciation. Then we will get NDP-MP. Okay, then if we subtract NIT from this NDP-MP, what we will get? NDP-FC. So minus NIT, then we will get NDP-FC. Then if we add NFI-FA along with this NDP-FC, what we will get? NNP-FC. So just to add NFI-FA, then we will get NNP-FC, and this NNP-FC is equal to national income. So listen carefully. Firstly, we need to add value added of each and every sector. Then we will get GVA-MP. That GVA-MP is equal to GDP-MP. That GDP-MP, from this GDP-MP we can calculate NDP-MP by subtracting depreciation, and from this NDP-MP we can calculate NDP-FC by subtracting NIT, and from this NDP-FC PFC we can calculate NNPFC by adding NFI FA. So this is the method of calculating national income using which method? Value added method. Now we can solve this value numerical question related with this value added method. Okay, so here the information is given as sales by A is given as 100, then purchase from B by A. Purchase from B by A, it is 40. So this is the intermediary cost of or intermediate cost of firm A, because firm A is purchased from firm B. Okay, next one, purchase from A by B. That means B is purchased some commodity from A, that is 60. So it will be the intermediate cost of firm B. Next one, sales by B, that is 200. Then closing stock of firm A, it is 20. Closing stock of firm B, it is 35. Opening stock of firm A, it is 25. Opening stock of firm B, it is 45. And indirect tax paid by firm A as well as firm B, it is 30. And here you need to calculate value added by firm A and value added by firm B. At the same time calculate GVA FC also. So firstly we can calculate value added of firm A. Value added by firm A. So what is the formula of value added? Value added is equal to value of output minus intermediate cost. For calculating this value of output, we can use three formulas. One is value of output is equal to price into quantity. That we cannot use this form in this example because price and quantities are not given. Second formula, it is value of output is equal to sales. Okay, so in this formula we can use only if the producer can sell his entire output. Here the producer cannot sell his entire output because opening stock and closing stocks are given. So which formula we can use? Third formula, that is value of output is equal to sales plus change in stock minus intermediate cost. So what is sales of firm A? Sales of firm A, it is 100 plus change in stock. Change in stock, what is the formula of change in stock? Closing stock minus opening stock. So closing stock, how much? Closing stock of firm A, it is 20 minus opening stock of firm A, it is 25 minus intermediate consumption, that is cost of raw material. So cost of raw material means whether the firm is purchased any commodity from other firm or not. Here firm A is purchased from firm B of rupees 40. So intermediate cost is equal to 40, that is equal to 100 minus 100 plus 20 minus 25, it will become minus 5. Then 100 minus 5 minus 40, that is equal to 55. So 55 is the value added by firm A. Like that we can calculate value added by firm B, that is equal to same formula, sales plus change in stock minus intermediate consumption. Then sales is how much? Sales by B, it is 200 plus change in stock. Change in stock means closing stock of firm A. Closing stock of firm B, it is 35 minus opening stock of firm B, it is 45 minus intermediate consumption, that is purchase from firm A by firm B, it is 60. That is equal to 200 minus 10. 200 minus 10 minus 60, that is equal to 130. So 130 is the value added by firm B. And if we add the value added by firm A and firm B, then what we will get? GVA MP. So GVA MP is equal to value added of firm A plus value added of firm B, that is equal to 55 plus 130, that is equal to 185. So GVA MP is equal to value added of firm A plus value added of firm B, that is equal to 185. Next, second question, that is calculate GVA FC. GVA FC. How we can calculate GVA FC? We already got GVA MP. So GVA MP minus NIT, net indirect tax, that is GVA FC. Then GVA FC is equal to GVA MP. We already calculated 185, and now we need to check whether NIT is given or not. So NIT is not given. Instead, indirect tax paid by A and B are given. Subsidy is not given. So no need to calculate NIT. We can directly subtract indirect tax. Okay, if subsidies and indirect taxes are given, then only we can calculate NIT. Otherwise, if indirect tax only given, then we can subtract. Otherwise, if we get only subsidy, then we need to add. Got it? So GVA FC is equal to GVA MP minus indirect tax, that is equal to GVA MP, it is 185, and IT it is 30, that is equal to 155. So GVA FC is equal to 155. Firstly, we calculated value added of firm A by firm A, and the second one value added by firm B. Then we added both the value added. Okay, then we got GVA MP. From this MP we can easily calculate FC by subtracting NIT. So we used that formula, and finally we got 155 as GVA FC. Okay, now we can solve some numerical question
we can discuss
related
some
with the
question from this part.